Hello, this week we're going to be learning about the Federal Reserve Bank and monetary policy. So in this first video, we're just going to talk about the structure of the Federal Reserve Bank, its goals, what it does, and how it's sort of set up. And then in a later video, we're going to go through monetary policy, which are the specific actions that the Federal Reserve Bank can take to influence the economy. Okay, so the Federal Reserve Bank is often referred to as the Fed. So sometimes this gets confusing because we're also going to be talking a lot about the federal government. And so sometimes people get mixed up when they see the Fed and think, is this the government or the bank? So just remember, the Fed is the bank. So the Fed is the central bank of the United States, and they undertake monetary policy, or these are the actions that they take to influence the economy. They set their own monetary policies and they carry them out. So their goals are that the economy should have stable prices, which is like low inflation or some kind of predictable level of inflation, low unemployment, and economic growth. So the Federal Reserve System was actually established by Congress in 1913. And there's actually something called the Federal Reserve Act that created the bank, or created this entity. So it provides for the establishment of Federal Reserve banks to furnish an elastic currency, to make loans to banks, to establish a more effective supervision of banking in the United States, and for other purposes. So this is the main bank in the U.S., the main banking governing body. It's set up into different districts, but they regulate and supervise the different banks around the United States. They also play a really big role in the money supply, managing the money supply, and making sure that there's enough digital currency to meet the needs of the economy. So we'll get into all of those details later. In 1978, there is the Humphrey-Hawkins Act, and this says that the United States should have an unemployment rate of 4% or less, inflation of 3% or less, and that the Fed's Board of Governors needs to report to Congress twice a year about the monetary policy that they're doing. And so the central bank is separate from Congress and separate from the president. They have their own things that they're allowed to do, their own actions they can take, their own things that they can govern, that's separate from things that Congress and the president can do. Now, Congress and the president do have a role in appointing the president or the chairman of the Federal Reserve Bank, but otherwise it is independent because it's supposed to be somewhat outside of the political process and not swayed by any particular political party. So here at the top of this chart, sort of a visual representation, is we have the Federal Reserve System. So there is one U.S. central bank, and it is broken up into three different chunks. So first, there's the Federal Reserve Board of Governors. There are 12 Federal Reserve banks, and there's the Federal Open Market Committee. So all of these three have their own separate areas, separate things that they do in managing the banking system and the economy. And so they have 5 key functions. So they conduct the nation's monetary policy, which we'll talk more about in the next video. They help maintain the stability of the financial system. They help supervise and regulate financial institutions. They help foster payment and settlement safety and efficiency, and they promote consumer protection and community development. So one example we could look at is in early 2023, there was an issue with some of the banks. So Silicon Valley Bank, for instance, and they took on some risky investments, potentially lent out too many reserves, and when their customers panicked, they didn't have enough funds to withdraw or to cover withdrawals. They had to cash in some of their investments, and then essentially that led to them going out of business. Now, part of that is that the Fed stepped in and said, you must go out of business. We are forcing the sale of SVB Bank to another bank. And partly, this has to do with helping maintain the stability of the financial system and supervising and regulating financial institutions. So SVB didn't necessarily break any particular rules when they were, operating their bank. They did take on quite a lot of risk, and there's some questions as to whether they were doing a good job managing the bank. But when they started to fail, the Fed wants to step in to help maintain the stability of the financial system, because one of the big problems with the financial system is that it's based on consumer confidence. It is based on us trusting that we're not going to lose our money if we put it in the bank. And so they wanted to step in and say, we're going to make sure your money is safe. So the FDIC said they're insuring all deposits for that bank. And the Fed said the bank is going to have to be sold to another financial institution that can handle their level of clients and, cover those reserves. And so this helps maintain the stability of the financial system, because customers at other small banks don't have to panic that their bank might go out of business as well. And then it's part of the supervising and regulating of financial institutions, because the Fed gets to decide if banks are allowed to operate, if they're operating, within the normal guidelines, if they've taken on too much risk and things like that. So they protected consumers. They helped make sure that there was elastic or a liquid currency, and they also tried to discourage other banks from making similar risky decisions. So they want to say, you aren't going to be protected if you lose too much money or you make too many risky decisions. We'll protect your customers, but we're not going to protect the bank. So the Federal Reserve is actually split up into 12 different regions. You can see in this map, it's split up by colors. You can also see the numbers, regions 1 through 12. So when this was set up, the East Coast was much more heavily populated than the West Coast. So you can see region 12 has way more states than region 1 or region 2 or 3. And that's because it was based on population at the time. So each of these sections has their own regional bank, their regional Federal Reserve Bank, that conducts their own regulations and banking monitoring of the area. In California, we're in region 12. Our bank is in San Francisco. Federal Reserve Bank is in San Francisco. So this is interesting to you. You might want to work at the Federal Reserve. You can go up to San Francisco and do so. So Congress oversees the Federal Reserve System and its entities, but they're also separate. So the Board of Governors in the Federal Reserve is an independent agency of the federal government. Congress and the President can't require them to do something specific. So if the chairman of the Federal Reserve does something that the President doesn't like, too bad. Like, they're not going to lose their job, right? So the President doesn't have that much control over it. But when their term ends, or if they retire or quit, then the President or whoever is in charge, they can sort of try to pick something that maybe matches better with their political leanings. So the Board of Governors does a lot of stuff. We'll talk about that more in monetary policy video. And then we have the Federal Open Market Committee. This consists of the members of the Board of Governors and some of the Reserve Bank presidents. So you're going to see 12 people on this Federal Open Market Committee. And then the Federal Reserve Banks, the individual regions, they have their own main bank. It's the operating arm of the Federal Reserve System. And each of those are supervised by the Board of Governors. So there's a lot of separation of power, a lot of independence, so that people are not necessarily swayed by some of the politics, and taking that away potentially leads to better policies. Okay, so the Federal Open Market Committee, they do most of the stuff that we hear about from the Fed. Anytime you hear the news or anyone talking about interest rates are going up or interest rates are going down, they're usually referring to actions taken by the Federal Open Market Committee. So it consists of 12 voting members. So the 7 members of the Board of Governors. The president of the Federal Reserve Bank of New York is also always on this. And then 4 of the remaining 11 Reserve Bank presidents who serve on 1-year rotating terms. But generally, all of these 11 Reserve Bank presidents go to the meetings. They can all comment, but it's only whichever 4 are officially on the board at the time, or on the committee at the time, actually vote for the policies. They all participate in discussion. Only the presidents and people on the committee members vote in policy decisions. So the FOMC is charged with overseeing open market operations. This is the principal tool by which the Federal Reserve executes monetary policy. These operations affect the federal funds rate, which in turn influences the overall monetary and credit conditions. It can affect aggregate demand. It really does affect the entire economy. So they also direct operations undertaken by the Federal Reserve in foreign exchange markets and currency swap programs with foreign central banks. So this is a really important committee. They probably do the most visible aspects of the Federal Reserve, and we'll talk more about what types of actions they take and how it influences the economy in another video.